In the women entrepreneurship, I'm dealing with a role of financial institutions in support of women entrepreneurial activities. Today we'll see about long-term and short-term financing. Till now, we have studied all these things: SI, DBI, DIC, CEDOK, RUD, SETI, SFC, EDII, KVIC, and even we have seen EDPs, that is Entrepreneur Development Programs. Today we'll go for this last topic, that is long-term and short-term financing. So already we have been studying about financing, and even in financial accounting you have come through terms called as long-term and short-term. Okay, short term is 6 months or less than 6 months. Sometimes it is 3 months or less than 3 months. Whenever we say long term, it is more than a year. So what are these things? Finances, as you all know, this is a must for any type of business. Whatever you do, finance is a must. So here you see, financing is an important part of every business, very important part of every business. Firms often need financing to pay their assets, equipment, and other important items. Financing can be either long-term or short-term. As is obvious, long-term financing is more expensive as compared to short-term financing. There are different vehicles through which long-term and short-term financing are made available. This chapter deals with the major vehicles of both types of financing. The common source of financing are capital that is generated by the firm itself, and sometimes it is capital from external funders, which is usually obtained after issuance of new debt and equity. A firm's management is responsible for matching the long-term and short-term financing mix. This mix is applicable to the assets that are to be financially as closely as possible regarding timing and cash flow. Okay, so what did you understand by this? We have been studying about long-term finance and short-term finance. So I'll just take you back to your accounts. Already you are dealing with accounts. In the accounts, at the end, we prepare final accounts. In that final accounts, what we have? Balance sheet. Okay. In balance sheet, we have asset side and liability side. Liability is nothing but it includes equity and liability. What is that equity, or we call it as a capital? Capital means what? That is the money that has been required or taken up to start a business, or which is for the business. What is that capital? It includes equity, preference, debt. Equity, preference, usually we go for general reserve, all these things which includes into capital. So now what do you mean by equity? What is preference? What is debt? This you should be very, very clear. Till now you have been doing it. Once you come to final year, you'll be going for financial management, where it is purely on equity. What is equity? What is capital? That you will be studying. So what is that equity? Consider you want to start a business. When you want to start a business, you want the total estimated finance, what you have calculated is rupees 1 lakh. Okay. So consider you don't have 1 lakh rupees. You just have 50,000. Then what you will do with that another 50,000? You require another 50,000. What you can do? There are many options. You can go for equity. Equity means your friend or your family member is giving 50,000 to you, and what he or she says, I also will be a part of your business. That is equity. Or your friend will give you 50,000, and what she will say, you have to give me interest on your profits. So interest, or you call it as dividend on the profits, that is preference shares. Or one of your friends says, I'll just give, you have to compulsorily pay me the interest, that is debt. These are the three main finances, long-term finances. Okay, so we'll study how you have to take it. What are these role for women entrepreneurship to start their business? That we will study over here. So long-term financing is usually needed for acquiring new equipment, R&D, that is research and development, cash flow enhancement, and company expansion. It may be a start of a new venture. You want to purchase a new equipment. You want to start R&D, research and development program, or it may be starting of another branch. That is, you're expanding your company. For anything, you may require the finance. Some of the major methods for long-term financing are discussed below. First one is equity financing. As I've told you, equity financing means who are those equities? They are also considered as the owners. So here, whenever I say here equity, I'm not particularly speaking about equity shareholders. It may be preference also. For both of these, we are giving dividends. Equity shareholders are always the owners. So just by one small video, you will understand what is this equity shareholder. You can see this, girls? All of you can see this? Hear the music?
No, ma'am.
No, ma'am.
So understood what is equity sharing, equity financing. Okay. That video was really wonderful. I think you might have understood it very, very clearly. The girl named, all of you can hear me, no?
Yes,
Yes,
ma'am.
ma'am.
Yeah, a girl like you, she wanted to start a business. But when her business started growing, she employed some employees. She wanted certain equipment. She wanted to expand her business. But for that, she required financing. When she went to bank, they asked surety, debt, loans, interest, everything. So she was confused what to do. Her brother understood what has happened, what is happening to her, and she gave her an offer. What he said, I'll give you money, but what was the condition? I also will be the owner. A equity share I want. From what? From the profits. So that's not a big deal. Like together they are starting a business. She will be at the head portion. She'll be doing that. And you have certain directors. They are all equity owners. Like this, you may have any number of equity shareholders. They are all considered as owners, and the profit available for equity shareholders, we say, that means whatever profit you earn, get from income and expenses statement, you call it as net profit. In that net profit, you have already removed taxes and interest. Now again, what you have to remove, deduct from that, dividend to preference shareholders. Whatever other things remains, that is a pure profit for equity shareholders. Okay, so this is equity financing. Next, we'll see this corporate bond. What is this corporate bond? I will show you this video over here again. By this video, we have tried to understand what is this corporate bond. So what did you understand? Now consider you have started earning. You have started a very nice job. You have started in business which giving you lots of money and you have lots of fund. Now you want to invest it somewhere else. You want to invest it. So such things we call them as corporate bonds. So what do you do is you want to invest where you select certain companies, very high branded company which are very successful. You can invest there. You have 1 lakh rupee, you can invest there, and every year or monthly they give you certain interest on that, or it may be more than 1 year also. When you are investing in a very good company, it is of less risk and your interest payment also may be low. But there is type 2, he said. What is that? You're taking a risk and you're investing in a startup companies or a new companies or not such a well-known companies. There the return may be more, but what will happen is the risk is high. So these are corporate bonds. Next, we'll see about capital notes. So capital notes are a type of convertible security that are excisable into shares. They are only one type of equity vehicle. Capital notes resemble warrants except the fact that they usually don't have an expiry date or an excise price. That is why the entire consideration the company aims to receive for the future issuance of the shares is generally paid at the time of issuance of capital notes. Many times capital notes are issued with debt for equity swap restructuring. Instead of offering the shares that replace debt, in the present, the company provides its creditors with convertible securities, the capital notes. Okay, so instead of going for equity, because equity you have to pay a lot. Not only that, you are taking them as the owner, so you don't want to do that. Debt pricing also will be very high. You have to give them interest whether you earn profit or no, you have to give. So that's why sometimes we shift to capital notes. Next comes as short-term financing. Okay, in long term you have equity financing, or you can go for corporate bonds, or you can go for capital notes. Short-term financing. Short-term financing with a time duration of up to 1 year is used to help corporations increase inventory orders, payrolls, and daily supplies. Short-term financing can be done using the following financial instruments. This is for less than 1 year. Short-term financing. What is that? First one, commercial paper. Commercial paper is an unsecured promissory note with a pre-noted maturity time of 1 to 364 days in a global money market. Originally, it is issued by large corporations to raise money to meet the short debt obligations. It is backed by the bank that issues it or by the corporation that promises to pay the face value on maturity. Firms with excellent credit ratings can sell their commercial papers at a good price. Okay, so commercial papers are nothing but corporate bonds only. It is similar to corporate bonds, but these are for a short term. They are not considered for long term. This is with the help of companies or the banks. This also I'll show you a video. Okay, first we'll see this video. Let me know if you can hear the voice over here. Can you hear?
Commercial paper
Yes,
is
ma'am.
long-term debt security issued by financial companies and large corporations. The corporation promises the buyer a return or profit for making the loan. The return is stated as an interest rate or percentage of the loan, such as 5%. Companies sell commercial paper when they need a short-term loan to pay for such things as accounts payable and inventories. The security is generally sold at a discount and redeemed at full value. The gain is the interest payment. Most commercial paper matures in 1 to 6 months, but some mature in up to 9 months. Debt that matures in less than 270 days, the money markets, does not require registration with the SEC. Debt maturing in more than 270 days, the capital markets, must be registered with the SEC. Commercial paper is part of the money markets. By avoiding SEC registration, it is less costly, a major benefit for companies. By issuing commercial paper to raise short-term funds, companies avoid the time and cost of applying for business loans, as well as SEC registration. Commercial paper is unsecured, meaning buyers have no claim on a company's assets if the company fails to pay up at maturity. Therefore, only firms with good credit can successfully sell commercial paper. Commercial paper is traditionally sold in large denominations of $100,000 or more to large institutions and wealthy individuals. However, it is increasingly becoming more available to retail investors.
Yes, commercial paper you have understood, I think. It is just like as I told you, corporate bond, but what happens over here? You don't have any claims. You cannot claim. Moreover, no registration is required. Now, if a bigger company is like, I want money, consider I have a business, I want money for short terms. I want to purchase some inventories, raw materials and all. I want money. So I will ask you, I will ask certain banks, I will ask certain companies. They have these persons, they have contact of these persons who want to invest. What they will do, they will invest. That is called as a commercial paper, just a paper form. It is just a form filling and you are going to give the money, but it is totally a risk. If I don't pay back you any interest or your principal amount, you cannot claim any asset on me, because there is no registration, there is no guarantee. Okay, but usually the companies do not do that. The corporate companies, they don't do that. They give good interest on this. Why they go for commercial paper is, there is no cost of registration, there is no waste of time, it is very fastly done, no registration, and the cost is less. Similarly, we have some more here. Asset backed commercial paper, ABCP, is collateralized by other financial assets. ABCP is a very short term instrument with 1 to 180 days maturity from issuance. ACBCP is typically issued by bank and other financial institutions. You see, what is this?
Growing businesses need a hosting solution that is powerful yet easy to manage. Let's look at how business
Hello, David Harper of Bionic Turtle with a brief illustration of the asset-backed commercial paper conduit. First, about the motivation. If we think about a company that manufactures a product and then ships that product to its customer, along with the product, it will typically ship an invoice, such that the customer doesn't typically return cash to the company immediately, but rather waits a few days. It's as if the customer has a charge card. That invoice represents the receivable, the trade receivable that is carried on the company's balance sheet as an asset, minus some allowance for the doubtful accounts. All other things being equal, the company would probably prefer to convert the asset, the trade receivable, into cash as quickly as possible. And broadly, there are three ways to do this. First, by discounting the invoice. The invoice may contain favorable terms that motivate the customer to pay cash almost immediately. Secondly, the company can factor, which is to sell these receivables, these assets, to a third party in exchange for cash immediately. And third, the company can engage an asset-backed commercial paper conduit. And so that's what we'll look at. Just keep in mind, it's a vehicle, a way to convert a trade receivable, which is the promise of the receipt of cash from the customer, hopefully very soon. It's a way to convert that asset into cash more quickly. We can start with the bank or the sponsor, which typically has a relationship with several companies. Each of those companies has trade receivables. And then there's a creation of the asset-backed commercial paper conduit. This is the special purpose entity which is created. And that conduit purchases the receivables from the companies in exchange for an interest in those receivables, the conveyance of the principal and interest. So notice at this moment, the companies who have these short-term assets, these trade receivables, have monetized them because the conduit has purchased them. Where did the conduit get the cash to purchase the receivables? It gets the cash from the investors. The conduit issues commercial paper to the investors in exchange for their cash. That's the cash that's used to purchase the receivables. So the receivables are generating the cash flow into the conduit. The conduit is returning this cash flow to the investors who hold this commercial paper notes. Traditionally, the bank or sponsor tries to retain an equity or residual tranche. We saw this before in the CDO structures. So let me make two final points about this. In regard to the cash flow, if we think about the receivable cash flow that's being generated, it typically does not have a maturity. Companies expect to be paid, say, in 30 days, but oftentimes those obligations go longer. Oftentimes it does not bear any interest, as opposed to the notes, the commercial paper sold to the investors. Those typically have floating rates, they do bear interest, and they have short-term maturity. So there is a dramatic mismatch in regard to the cash flows, which makes the support mechanism to the conduit very important. So support in two forms: credit support and liquidity support. This credit and liquidity support is helping the conduit manage the cash flow mismatch between these receivables, which are somewhat erratic, non-interest bearing, and this commercial paper notes, which tend to be a floating rate with short-term maturity. Traditionally, the bank tried to provide both roles under FIN 46. The bank has grave difficulty providing both credit and liquidity support. And the second point I'd make about this is that it's not a one-time event. It is what's called a continuous conveyance. The conduit is continuously purchasing an interest in these receivables and funding this with a continuous rollover, so to speak, of commercial paper to the investors. So you can think about this in dynamic terms. So this is David Harper, the Bionic Turtle. Thanks for your time.
In order to
Yes, we have seen this asset-backed commercial paper. Hope it was very, very interesting. All of you have understood this. Have you understood this? It was explained very nicely. Consider you are a very big company and you have purchased raw materials, but you don't have amount to pay. Okay, so for all these financing modes, there are bank and financial institutions where there are investors. Okay, so what, with the help of this bank support, there is a mediator, conduit we call. So he connects investors and the company. He is acting as a mediator person. Okay, so that investors pay for these raw materials, the company uses it, and it goes on paying back the interest and principal amount. If he doesn't pay, what happens? It is asset backed. The asset will be in the name of those investors. Clear about this? Next we have a promissory note. Okay, we'll see this also.
A promissory note is a written promise by one party to pay another party a specified sum of money either on demand or at a specified future date. It is commonly used in business as a means of short-term financing. For example, when a company has sold many products but not yet collected payments for them, it may become low on cash and unable to pay its own creditors with cash. In this case, it may ask its creditors to accept a promissory note that can be exchanged for cash at a future time after it collects its accounts receivables. Alternatively, it may ask the bank for the cash in exchange for a promissory note to be paid back in the future. Promissory notes lie between the informality of an IOU and the legal rigidity of a loan contract. A promissory note generally contains all the terms relevant to the indebtedness, such as the amount, interest rate, maturity, maturity date, date and place of issuance, and issuer's signature. It is usually held by the party that is owed the money and returned to the issuer when payment is made. It does not usually explain methods of recourse if the issuer does not pay on time. When such a note is unconditional and saleable, it may be sold as a financial instrument. These are often called negotiable instruments.
Okay, that is promissory note. What is that promissory note? It is a certificate in the form of cash. When you give that certificate, it will be converted to cash. Now consider I am a business holder, or you are a business person, you have very big industries, and you're doing business. As you're in the process of your business, you do not have cash to pay back your creditors. So instead of cash, what you do is you give them a promissory note. So what is that note? It indicates it is in terms of cash only. And there you deal with the bank. When you start getting your profits, once you sell and you start getting your profits, or when your debtors pay back you amount, then you invest in the bank and the bank goes on paying it. It's a short term. And you have one more asset based loan. It is same like what you have seen in asset backed. It's a type of loan which is often short term and is secured by the company's assets. Real estate, accounts receivable, inventory and equipment are the most common assets used to back the loan. The given loan is either backed by a single category of assets or a combination of assets. Next, you have repurchase agreements. This also I'll show you.
A repurchase agreement is the equivalent of a short-term collateralized loan. An owner of marketable securities sells those securities to a buyer for cash. As part of the deal, the seller agrees to buy back the securities at a later date. That later date, the next day, or maybe the next week. The price paid to repurchase the securities is higher than the original selling price. The spread between the original price and the repurchase price is equivalent to interest. Repurchase agreements are often used by institutions with available cash that are looking for quick, easy ways to get a return on their money with little risk. Shelley has $1 million in treasury bonds. Lindy has $1 million in excess cash and wants to earn some revenue without tying it up in a long-term investment. Shelley is the seller and borrower in the repurchase agreement. Lindy is the buyer and lender. Shelley agrees to sell the treasury bonds for $1 million, but on the condition that she buys them back from Lindy next week for $1 million plus an additional $956. The $956 is considered the equivalent of interest. One risk to keep in mind, the original seller might be unable to repurchase the securities. In that case, the buyer has the right to sell the securities on the market. To mitigate this risk, repurchase agreements are usually collateralized with securities with a market value in excess of the amount paid for them.
Yes, that was a repurchase agreement. So what you do in this repurchase agreement, you're selling what your shares to another person. Okay, it may be for 1 day, 1 week, 1 month, anything. Okay, so later on she will repurchase it on a condition that she will buy it back. But when she is buying it back, she is paying a extra amount that we call it as an interest. If she is not able to buy it, then what she will do? She will let the other person keep that shares, and that person may sell it. Okay, that is repurchase agreements. Then you have a letter of credit. I have a video for this also. We'll watch this.
85% of people working in a job, they don't like their job. As per the Gallup survey.
हेलो फ्रेंड्स, वेलकम अगेन फ्रेंड्स। आज इस वीडियो में हम लोग डिस्कस करने वाले हैं लेटर ऑफ क्रेडिट। तो चलिए वीडियो को स्टार्ट करते हैं। तो ये एक एग्जांपल है। लेटर ऑफ क्रेडिट को समझने से पहले हम लोग एक सिंपल वे ऑफ ट्रेड को समझते हैं। देखिए स्क्रीन पे आपको यहाँ पर एक बायर और एक सेलर दिख रहा है। अभी हम एज्यूम करते हैं कि हम लोग अपने एक सिटी के मार्केट में हैं, जहाँ पर हम लोग को कोई चीज परचेस करना है। तो हम लोग क्या करते हैं, सेलर के पास जाते हैं और उससे परचेस करके उसको अमाउंट देके गुड्स को घर लेके आ जाते हैं। तो यहाँ पर बायर क्या करता है, इसको रुपीज देता है, यहाँ पर पैसे यहाँ पर देता है और गुड्स लेके चले जाता है। ये एक बिल्कुल सिंपल वे ऑफ ट्रेड है। सेलर के पास पैसा मिल जाता है सेलर को, और बायर के पास उसको गुड्स मिल जाता है। तो ये तो हमने देखा कि कितना सिंपल वे है एक ट्रेड करने का। तो अब फ्रेंड इमेजिन करिए कि बायर और सेलर दोनों डिफरेंट कंट्रीज में है, या अगर किसी एक कंट्री में भी है पर दूर रहते हैं काफी, तो उनके लिए ट्रेड करना कितना डिफिकल्ट हो जाएगा। क्योंकि बायर यहाँ पर पहले बोलेगा कि आप एक काम करिए, पहले मुझे गुड्स दे दीजिए तो मैं आपको फंड दे देता हूँ। सेलर बोलेगा कि पहले आप मुझे फंड्स दे दीजिए, उसके बाद मैं आपको गुड्स की डिलीवरी कर दूंगा। तो इनके लिए थोड़ा सा कंफ्यूजिंग हो जाएगा। ये वही है कि जूते दो पैसे लो, पैसे दो जूते लो, इस काइंड की सिचुएशन खड़ी हो गई यहाँ पर। तो आपने कभी फ्रेंड्स ये इमेजिन किया है कि ये लोग फिर ट्रेड कैसे करते होंगे? तो यही हम लोग आज डिस्कस करने वाले हैं। तो टू ओवरकम द सिचुएशन बिटवीन द बायर एंड सेलर, कि जहां पर बायर बोल रहा है कि पहले आप मुझे गुड्स दे दीजिए, सेलर बोल रहा है कि पहले आप मुझे फंड दे दीजिए। सो वी इंट्रोड्यूस लेटर ऑफ क्रेडिट हियर, एलसी, और एलसी को ही हम लोग बोलते हैं डॉक्यूमेंट्री क्रेडिट। तो अब ऐसा कुछ करना है जहां पर बायर और सेलर दोनों मिलकर ट्रेड कर सकें। तो ट्रेड करने के लिए सबसे पहले लगता है ट्रस्ट और रीच, तभी तो वो फंड ट्रांसफर नहीं कर रहा है और वो गुड्स ट्रांसफर नहीं कर रहा है। तो कुछ ऐसा चाहिए जिसपे दोनों ट्रस्ट कर सके, पहुंच सके। तो एक ऐसा मीडियम है बैंक। बैंक एक ऐसा मीडियम है जहां पर बायर भी पहुंच सकता है और सेलर भी पहुंच सकता है, और दोनों अपने अपने बैंक के ऊपर ट्रस्ट कर सकते हैं। तो बैंक यहाँ पर एज ए इंटरमीडियरी काम करता है और दोनों की ट्रेड को पॉसिबल करता है। तो फ्रेंड्स अब हम लोग ये देखते हैं कि फाइनली जो हमारा लेटर ऑफ क्रेडिट है वो वर्क कैसे करता है। तो देखिए यहाँ पर आपको दिख रहा है कि ये है बायर। बायर को हम लोग यहाँ बोलते हैं ओपनर और एप्लीकेंट, ठीक है। तो ये वो बंदा है जिसको गुड्स परचेज करना है। तो ये अपने बैंक के पास जाता है। लेट्स से कि वो बैंक है आईसीआईसीआई बैंक, जो कि इंडिया के अंदर है। उस बैंक को हम लोग बोलते हैं ओपनिंग बैंक या इशूइंग बैंक, जो लेटर ऑफ क्रेडिट को ओपन करता है। तो इस बायर ने सारी डिटेल्स जो है सेलर के बारे में इस बैंक को बता दिया है कि जो सेलर है वो उसका अकाउंट जो है वो एचएसबीसी के साथ में है और मैं उससे मटेरियल परचेस कर रहा हूँ यहाँ पर। तो ये बैंक जो है अपने बिहाफ पे इसकी बैंक को कांटेक्ट करती है, उसको हम लोग बोलते हैं एडवाइजिंग बैंक। सेलर की बैंक को कांटेक्ट करती है और जो एलसी है, जो उसने एलसी ओपन की थी, वो एडवाइजिंग बैंक को सेंड कर देती है। एडवाइजिंग बैंक के पास एलसी आने के बाद एडवाइजिंग बैंक कांटेक्ट करती है सेलर से और आस्क करती है, उससे पूछती है कि आपका एक एलसी ओपन हुआ है इतने अमाउंट का। तो उसके बाद सेलर इसको कंफर्म करने के बाद गुड्स को डिस्पैच करता है। गुड्स को डिस्पैच करता है। गुड्स सेंड करने के बाद, डिस्पैच करने के बाद जो डॉक्यूमेंट्स है वो एडवाइजिंग बैंक को दे देता है। एडवाइजिंग बैंक उस डॉक्यूमेंट को दे देती है इशूइंग बैंक को, और इशूइंग बैंक वो डॉक्यूमेंट देता है जो बायर है। बायर को वो डॉक्यूमेंट्स मिल जाते हैं। तो बायर वो डॉक्यूमेंट को, जो भी अमाउंट होता है वो इशूइंग बैंक के पास अमाउंट देने के बाद वो डॉक्यूमेंट्स ले लेता है। उस डॉक्यूमेंट्स को वो गुड्स, तो डॉक्यूमेंट लेने के बाद वो इन गुड्स को ले लेता है। तो इसमें एडवाइजिंग बैंक के यहाँ पर हमारे पास दो और बैंक होती है सेलर की कंट्री में। जो एडवाइजिंग बैंक होती है वो सेलर की कंट्री में होती है। एडवाइजिंग बैंक को कभी कभार कंफर्म करने की जरूरत पड़ती है, तो कंफर्मिंग बैंक भी होती है, और एक बैंक और होती है रीइंबर्समेंट बैंक। अभी जो मैंने आपको एलसी की प्रोसेस दिखाई है बड़े इजी तरीके से दिखाई है। ये जितना इजी मैंने समझाया एक्चुअली में इतना इजी है नहीं। इस प्रोसेस को अगर अपन डिटेल में समझें तो हम लोग इसके लिए एक सेपरेट वीडियो बनाएंगे जहां पर हम एलसी की प्रोसेस को सेपरेट समझने की कोशिश करेंगे, जहां पर हम लोग डिस्कस करेंगे कि एडवाइजिंग बैंक क्या है, इशूअर कौन है, इशूइंग बैंक क्या है, उसके पास के पावर्स क्या हैं, और कंफर्मिंग बैंक की क्या रोल है, रीइंबर्समेंट बैंक की क्या रोल है, टाइप्स ऑफ एलसी क्या है। तो इसके लिए हम एक सेपरेट वीडियो बना रहे हैं। तो फ्रेंड्स अगर आपको ये एलसी का टॉपिक समझ में आया तो वीडियो में जरूर कमेंट करके मुझे
So this is the letter of credit, especially when it is between two countries or two different states also, we go for this letter of credit. So this is all what we have with long-term and short-term financing. So equity financing, corporate bond and capital notes are the long-term financing. In short-term financing, you have commercial paper, asset-backed commercial paper, then promissory notes, asset-based loans, repurchase agreements, letter of credit. Okay, so all of you are clear about this, that is long-term and short-term